Treasuries are falling for a second day in a row, pushing up yields once again ahead of big auctions. Next week, the Treasury will auction $104 billion worth of 2-, 5-, and 7-year notes. The U.S. may sell a record $3.25 trillion of debt this fiscal year, ending September 30th, 4 times what it sold last year. It's that huge jump in new debt that has bond investors pushing up yields, and our next guest avoiding Treasuries. Dan Fuss is the vice chairman of Loomis Sayles and helps to oversee $50 billion in bond fund assets. The Loomis Sayles Bond Fund, which he co-manages, has gained 17% this year and 6.91% annually for the 10 years ended in May. That's just a tad below the 6.92% that Bill Gross's PIMCO Total Return Fund has gained during those same 10 years. You like that, huh? We got you right in there behind Mr. Gross?
Right. Well, that's where I normally am, but just behind.
Mr. Fuss, welcome to Bloomberg News. Thank you so much. Treasuries down today. We had some relatively bullish economic data and concerns, as I mentioned, about that rising debt level. You're concerned about those debt levels. How so?
Well, I am. The obvious, you just put it real well. The Treasury is issuing a ton of new debt, and that's going to go on for a couple of years. Then it will ease off a bit and then start to rise again. So markets being markets, you don't have to hurry up and buy them now. You can wait a few more weeks and they'll be a little more attractive. So people will hold back to a degree. But it's that forward calendar. It's the Treasury borrowing requirement that's, monumental.
How serious is that debt level for the bond market?
Oh, very. Mark, that's the Treasury is your incremental borrower of funds right now, if you look at a flow of funds view. And they're going to be issuing a lot more. They'll get it done. You don't have to worry about them. But what does happen is you start to worry about the price. In other words, the interest rate. So with that staring at you, you're inclined to just, particularly at the long end, hold back.
You are, as I mentioned, avoiding Treasuries. What bonds are you favoring now?
Well, corporates, a little less than we were. The very high quality end of corporates, long, has been, until recently, a good place to be. They have, the difference in yield between those bonds and Treasuries, which was very wide, has come way in. So they're a little less attractive now. Looking forward, it's our guess about the future that interest rates will rise with fits and starts for a long time. So we're focusing on the 10-year range of corporates.
So you mentioned interest rates. How high do you expect them to go?
Oh, I never know. But I do have a benchmark here. If you'll remind me in about 5 years, my benchmark is I think the 10-year Treasury is going to something like 6 1/4.
Okay.
And where are we today? 380, 385. That's a big difference, and we may as well prepare for it.
Talk to me about foreign bonds. You like those?
Yes, it depends on the, now in the bond fund's case, we only can buy a certain amount.
Right.
It's not a global fund. It's got a fair amount of global. Consistent with our guideline limitations, with the exception of Canada, we have a full position offshore. We have a special limitation for Canada of 20%. We have that at 10% right now. The yield difference between the U.S. and Canada has gone away. But the rest of it, which is both in Asia, Latin America, and a little bit in Europe, we're full over there.
If inflation is a concern, are tips a good deal right now?
With a lag. Now, tips, it's a logical conclusion to go after tips, but you have a problem. Number one, you have to be careful. You only want to buy tips at issue. Number two, they don't trade well. Number three, the yields are still very low, and the CPI will lag here.
Okay.
For quite, and number four, most serious, what happens if the Treasury does what they say they're going to do, which is issue a ton of tips? So it's early.
So, well, at least in your mind, tips, we're thinking longer term here.
Right. But I wouldn't do tips for the next year or two unless, of course, the yields on tips go way up, which they're not.